Gold bars, foreign currency, overseas real estate, large-scale outflow of Chinese funds. Ineffectiveness of Policies, CCP introduces another 25 measures for private economy. Scholars warn, China's economic development at its limits, negative growth possible in the future. Economic collapse, intense internal strife make delivery of third plenary session of CCP challenging. It's all covered in today's China Truths. Gold bars, foreign currency, overseas real estate, large-scale outflow of Chinese funds. Since the Beijing authorities lifted the pandemic lockdown this year, China's affluent groups have transferred billions of dollars out of China through various means such as buying gold bars, stocks, insurance, overseas real estate, and depositing money into European and American accounts during travels. In recent years, despite Beijing's tightened measures on capital outflows, Chinese people have always found ways to circumvent these strict controls and transfer large sums of money abroad. The New York Times recently revealed some of the methods and ways in which Chinese rich are transferring funds overseas. The most common practice of asset transfer is purchasing small gold bars and large amounts of foreign currency, dispersing these in carry-on luggage, and depositing them into their accounts in Europe and America when traveling abroad themselves or through relatives and friends. Another common method of transferring assets is purchasing overseas real estate. Zhao Jia, phonetic, CEO of an online real estate listing service company in Tokyo named Kamikyo Soku-kei, disclosed that the Chinese have become the main buyers of apartments in Tokyo worth $3 million or more. Many Chinese buy luxury apartments in Japan to obtain investment visas, then relocate to Japan with their families. Zhao said, "They often pay with boxes of cash," adding that counting so much cash is really tiring. The report states that an average of about $50 billion per month has been flowing out of China this year, mainly from Chinese families and private enterprises. To stem the outflow of private capital, the Chinese police have intensified crackdowns on illegal foreign currency exchange spots in major cities like Shanghai and Shenzhen. Regulatory authorities have also closed nearly all gambling routes to Macau to prevent the wealthy from converting large sums of money into dollars while gambling there. However, wealthy families and enterprises still find ways to transfer funds overseas. Data released by the Hong Kong Insurance Authority shows that in the first half of this year, mainlanders traveling to Hong Kong to buy new insurance policies spent 21.3% more than in the first half of 2019. Additionally, China's national financial accounts covering stock markets, bond markets, and direct investments show that between January and June this year, $101 billion in net capital was withdrawn from China, the highest since 2016. The report quotes Alicia Garcia Herrero, chief economist for Asia at the French Foreign Trade Bank, saying, "It's not just that foreign asset managers are no longer investing in China, but the unrecorded outflows are increasingly worsening, and people want to take their money out." Ineffectiveness of Policies, CCP introduces another 25 measures for private economy. On November 27, the CCP's 25 measures for private economy officially took effect, including the Central Bank, the Financial Regulatory Commission, the Securities Regulatory Commission, and other major departments, jointly issuing a notice, demanding all-around strengthening of financial support for the private economy. In addition to demanding smooth diversification of financing channels, banking and financial institutions are required to increase support for first loans and credit loans, and not to blindly stop loans, press loans, withdraw loans, or cut off loans. The notice also requires expanding the scale of bond financing for private enterprises, supporting their listing and financing, and mergers and acquisitions. Wang Guochen, an assistant researcher at the Chinese Academy of Economic Research, believes that the loans of financial institutions to private enterprises might still be just lip service. Wang Guochen stated, "The first is the declining loan demand of private enterprises because for real estate or network platforms, or export-oriented manufacturing, their orders or overall atmosphere will cause their business volume or sales volume to decline." Wang further pointed out that the problem of borrowing difficulties for Chinese private enterprises still exists. Wang Guochen, the ability and credit of repayment are also problematic because state-owned enterprises will definitely be protected by the government, but private enterprises might become bad assets or non-performing loans if they go bankrupt. Wang Guochen, private enterprises account for more than 60% of China's investment, so if the investment of private enterprises is sluggish, mainland China's investment will not be good, and the entire Chinese economy will not be able to recover. Throughout the latter part of the year, the Chinese Communist Party implemented a series of measures to support the private economy. This included releasing strategies in July, August, and September, focusing on the growth, technological engagement, and legal protection of private enterprises. Additionally, the CCP uniquely established a dedicated development bureau for the private sector. But Wang Guochen believes that this series of policies supporting the private economy may not be very effective. He highlights the declining loan demands in sectors like real estate, network platforms, and export-oriented manufacturing. Wang Guochen, especially with the continuous release of laws such as the cybersecurity law or the anti-espionage law, it hinders the demand for information liberalization of network platforms. Therefore, it is difficult for the private economy of network platforms to develop. The last is the private enterprises in manufacturing. Due to the US-China trade war, a large number of orders have been transferred, and even the whole factory may have to be relocated overseas for production. For private enterprises in mainland China, it is not so easy for those manufacturers to survive. Moreover, the perceived higher risk and smaller loan sizes for private enterprises make banks hesitant to lend. Scholars warn, China's economic development at its limits, negative growth possible in the future. According to a report by Radio Free Asia, Thomas J. Duesterberg, a senior researcher at the Hudson Institute, a Washington-based think tank, pointed out in a seminar on the 28th that China's economic development has reached its limit. China's economy is likely to experience negative growth or face a severe economic crisis in the future because domestic economic pressures in China are continuously increasing. Duesterberg further noted that the current economic pressures in China, such as government debt issues and an oversupply in the real estate market, are causing economic weakness. Chinese banks and local governments bear over 85% of national public expenditures. Their current excessive leverage makes it impossible to continue borrowing to stimulate the economy. Infrastructure development is another traditional method to promote economic growth, but the inefficient investment by Chinese state-owned enterprises results in minimal profits, and local governments cannot encourage real estate construction by selling land ownership to fill fiscal deficits. Duesterberg also discussed the excessive investment by the Chinese Communist government in specific industries and the problem of insufficient market demand. He stated, China's excessive investment in specific industrial sectors, such as well-known ones like automobiles, electric cars, solar panels, and other products dumped by China abroad. The problems faced by Chinese banks and local governments lead to Chinese families accumulating precautionary savings, thwarting Xi Jinping's strategy to stimulate economic development by increasing domestic demand. The U.S. Congressional Executive Commission on China earlier this month released an annual report spanning over 700 pages, pointing out structural problems in China, including high youth unemployment rates, a lack of top talent in key areas, a sluggish real estate market, and insufficient domestic demand. These issues contribute to China's long-term competitiveness and a lack of social cohesion. Economic collapse, intense internal strife make delivery of third plenary session of CCP challenging. The recent session of the CCP Politburo has concluded, yet there is a conspicuous absence of information regarding the highly anticipated 20th third plenary session, initially slated for year-end. Traditionally, this session delineates the major political directions of the recently appointed leadership. The lack of news is viewed as abnormal by Guo Jun, the editor-in-chief of the Epoch Times, signaling significant pressure at the upper echelons of the CCP. High-ranking members are embroiled in intense internal conflicts, lacking compromise among various factions, primarily focused on addressing economic challenges. Recently, the CCP issued directives, including the 3 no less than, instructing major banks to provide almost unconditional loans to real estate companies. This marks a reversal from the 2017 3 red lines policy, designed to curb high leverage in real estate by restricting bank lending. Real estate, being debt-intensive, encounters operational difficulties without bank loans. Beijing's desperation is evident in these policy shifts, contributing to a chaotic situation marked by a lack of clear direction, consensus, or understanding, making the convening of the third plenary session challenging amidst this significant failure. Wang Huntao, chairman of the overseas branch of the China Democracy Party, noted in the Elite Forum program that traditionally, during the first term of each CCP leader, the third plenary session outlines the major political directions of their rule. For instance, Jiang Zemin's era proposed comprehensive reform and opening up during the 14th Congress after Deng Xiaoping's southern tour, initiating a market-oriented economy. This pattern continued with Hu Jintao, and when Xi Jinping assumed power during the 18th Congress, he advocated for the market's decisive role in resource allocation and emphasized private sector development. However, during that time, the third plenary session might not have been Xi's original intention, as he had just come to power and needed to compromise with various party elders. Ideally, Xi should present a comprehensive governance program during this session, but such ambitions typically require a positive economic situation to showcase a bright future. Given the current poor economic conditions, presenting such a program might not only fail to boost morale but also lead to more conflicts. The pressing questions now include the next steps and the extent of the economic downturn, with Xi Jinping currently lacking clarity on these matters. Xi Jinping faces a dilemma. As he aspires to advance novel ideas and establish a new framework, this trajectory risks exacerbating the economic decline. Conversely, retreating to salvage the economy demands embracing previously spurned approaches aligned with Li Keqiang and Deng Xiaoping, posing uncertainty. Opting for compromise requires meticulous balancing, complicating the determination of the opportune moment for the third plenary session, contributing to the challenges in convening the session. Wang Huntao stated, "If we delve into the history of the Communist Party, we observe that when the highest leaders confront significant economic challenges, no matter how resolute they may seem, they inevitably find themselves compelled to compromise." Figures like Mao Zedong, Stalin, and the three generations of the Kim family had to yield in the face of major economic crises, otherwise, maintaining their hold on power became untenable. In moments of compromise, the Communist Party tends to resort to intense purges. Take Stalin as an example. During times of perceived instability, like in the aftermath of Lenin's death within the old Bolsheviks when he held a relatively modest status, during the economic upheaval of the 1930s, Stalin executed a series of purges targeting individuals like Kirov, Zinoviev, Kamenev, Bukharin, and Rykov one after another. This ruthless purge forcibly surmounted challenges, leading to the starvation of numerous people. Mao Zedong followed a similar trajectory. In my assessment, Xi Jinping might adopt a similar strategy of intense purges. Despite the initial plan to foster unity this year with an emphasis on strength through unity and the value of confidence, we witness widespread purges across various sectors, encompassing the military and finance. Everywhere, these extensive purges unfold one after another. Consequently, I believe Xi Jinping grapples with a contradiction. On one hand, he recognizes the necessity of making concessions to avert economic calamity and potentially convene the third plenary session. On the other hand, he perceives an inability to afford concessions, given that he does not embody the stature of Mao Zedong but is rather a newly emerged leader. In this scenario, he may resort to intense purges, fostering internal conflicts and complicating his efforts to consolidate power. Wang Huntao suggests that Xi Jinping might adopt a similar purge strategy. Despite intending to foster unity and strength through confidence initially, Xi is presently overseeing extensive purges in various sectors, including the military and finance. Consequently, Xi confronts a dilemma. He recognizes the need for concessions to avert economic doom and convene the third plenary session, yet he hesitates due to his status as a newly emerged leader, potentially leading to internal conflicts and complicating efforts to consolidate power. Don't forget to leave a comment in the section below to share your opinions on today's topic with us. Make sure to like and subscribe to see more interesting topics from China Truths.